Hey, Gold Silver, Alan Hibbert here with another video. This time I want to walk you through the stock market because it's at record highs, which means the economy is doing record well, right? I'm not so sure. Let's look at some charts. First, I want to compare the S&P 500 now to in 1929, just before the Great Depression. And thank you very much to Kevin Smith for putting this together. The technical setup compared to 1929, combined with the valuation and market cap concentration similarities, should be top of mind. In other words, people should be paying attention to this and thinking about it. The S&P 500 now is in white. 1929 is in red. Look what happens next. Yeah, and correlation of 0.94. Of course, correlation is not causation, but these two patterns are very similar. Let's take a look at another trend. This is the dot-com era. So we can see that Cisco and NVIDIA looking similar. Cisco leading up to the dot-com boom and bust here in blue, NVIDIA in pink. So what happens next? You tell me. Here we have Stanley Druckenmiller commenting on the 1987 stock market crash. This is what he said when asked, what determined the timing of your shift from bullish to bearish? And of course, he's one of the greatest stock market investors of all time. Usually bullish, but he became bearish. Why? Well, he said it was a combination of a number of factors. Valuations had gotten extremely overdone. Okay, so high valuations. And the dividend yield was down to 2.6%. And the price to book value ratio was at an all-time high. Also, the Fed had been tightening for a period of time. Finally, my technical analysis showed that the breadth wasn't there. That is, the market strength was primarily concentrated in the high cap stocks, with the broad spectrum of issues lagging well behind. This factor made the rally look like a blow-off. So is there anything similar today? Does it also look like a blow-off? Let's take a look at valuations and dividend yields to see. First, we have the Shiller PE ratio. This is the ratio of price to earnings. So a stock market's price relative to how much they're earning as a company. And you can see back in 87, it went up to about 18 and then crashed down. And you can see compared to other crashes, we've had some other blowups. Look at this. In dot-com era, PE ratio of the S&P was up to almost 45. And where we are now at 34 is higher than we were in 1929. That peaked at about 31. Right now we're at 34. So it looks like valuations are even higher than preceding the biggest crash of all time. Looking at dividend yields, 1987, when we were down to about 2.6, 2.7, this is what Druckenmiller is talking about. At the time, these were record lows. But even after that stock market crash, we've gone even lower and even lower still. We're around 1.3% now, which is even half of where we were back in 1987. So you tell me, are we due for another crash or is this just normal? Moving right along, we get a reminder here from Charles Payne. Thank you, Charles, for reminding us that the stock market is not the economy. I can't tell you how many times I hear people say, oh, the stock market is doing well. That means the economy is doing well. They're not connected. And here is a chart that shows that. And then I want to explain the basic concept that underlies that. So here we have the S&P 500 in blue, and we have the truck tonnage index in yellow or gold. So this is truck tonnage, basically how much stuff is moving in trucks. That feels more like the real economy than stock prices. And you can see that they used to be pretty tightly correlated until around 2020. They split apart and truck tonnage has been relatively flat while the stock market is soaring. So there's a huge disconnect here between what feels like the underlying economy and the stock market, which is the, headline economy. So what's the principle that underlies this? Why could there be such a divergence here? Well, this is what's an example of what's called Goodhart's law. Goodhart's law, simply expressed, is when a measure becomes a target, it ceases to be a good measure. In other words, when we set one specific goal, people will tend to optimize for that objective regardless of the consequences. So what does this mean? Okay, we could think of examples from just about anywhere in life because it does apply everywhere, not just in economics. But the classic example I like is in academics. right? We all want our children to be smart, critical thinkers, well-read, mathematically literate, financially literate. And in order to measure that, which, it's a hard thing to measure, but in order to measure that, we give them grades, letters, numbers. You got 90% or 100%, you get an A or an A plus. But over time, students learn to chase the grades directly. And the grades no longer reflect the actual learning. And teachers do the same thing, and administrators, and the same thing happens with test scores. And because it's really hard to measure the thing we actually care about, like our students learning, it also happens in the economy. We want the economy to be strong. We want it to be vibrant, but it's hard to just know, is the economy good? How do we measure that? Well, the stock market is one proxy, but it's not an absolute. And over time, you get CEOs and other decision makers that actually go after stock prices directly instead of the actual business activity that should cause stock prices to go up down the road. And we also have the Federal Reserve lowering interest rates and flooding the economy with currency, and that causes stock prices to go up, even though there's no improvement in actual business activity. So that's how we can get a chart like what we just saw, where the stock market is completely disconnected from the underlying economy. And in my opinion, the economy is not as strong as the S&P 500 index would lead you to believe. And it's not just my word, it's also professional investors, it's insiders, it's CEOs, it's people who have been around a long time. Here we have a tweet from Anthony Pompliano. Jeff Bezos is selling a lot of stock. The last time he did this was at the top of the market in 2021. What does he know? What does he know that maybe we don't know? Another tweet here. Bill Gates is getting rid of his entire portfolio. Now, I don't know if that's true or not, but that's what this tweet says. Historically, the movement of billionaires of this magnitude indicate the imminence of a stock market crash. And there's a short video here, and I paused it with a clip about Jeff Bezos selling another $2 billion of Amazon shares, bringing his weekly cash total to $6 billion. So it's Jeff Bezos, it's Bill Gates, and it's also congressmen. In this video here, we see Nancy Pelosi and Tommy Tuberville selling a ton of their stock portfolios. Overwhelming majority of their trades are sells lately. What do they know? What do they know? You tell me. So I just want to return to this one that we started with, a friendly reminder that the S&P 500 now looks a lot like it did in 1929. And this isn't just a discovery that we're making now. In fact, Mike Maloney has been saying this for years, and he made this awesome video putting together the eerie similarities of the 1929 crash and today. This is an awesome presentation with so much data in it. He was really ahead of the curve, way ahead of all these other people. So I really encourage you to watch this video if you haven't watched it already. And thank you very much for watching today. Stay safe out there.